Hi members, and welcome to the first of our CEO interviews. My name is Mitchell Snedden and I'm joined by Manny Pohl, who's the CEO of a number of LICs. Manny, thanks for joining us.
Oh, it's a pleasure, always glad to be here.
Now, Manny, last time you were here, we spoke with you about Barrack Street, your LIC there. Now, there are two others that you also run. Can you give us a bit of a rundown of all three and how they fit in together?
Sure. I mean, Flagships is the oldest of the three. It's been around since '98, and it was set up as our retail exposure and to give retail investors obviously an exposure to what we do, which is a broad cap base. Over the years, with the advent of self-managed super and all of what that entails, we found that most of the moms and dads own the banks, they own the miners, they own Woolies, to name a few. And there was certainly a hole where they weren't prepared to go, which is where the real value can be created, and that's in the X50. So the smaller end of town is the more risky end, but you certainly need to do your homework. So we then decided to strip out that part of our normal portfolio and put it into an entity called Barrack Street. So that's the second LIC. The third one is Global Masters, and it's been there a lot longer than Barrack Street. And it was set up originally because we wanted an exposure to some international assets personally. That's myself and the family. And who better than Warren Buffett? But the problem was that $100,000 or whatever it was at that time, it was outside of the reach of us and most Australians. So we then set up an LIC where you could get in for $1 and get exposure to Berkshire Hathaway. Along the way, we've added Athelney out of the UK, so those are the two principal investments, is the Athelney in the UK, but the lion's share is in Berkshire Hathaway.
Why Athelney in the UK?
Well, it's a chap that I've known for 25 years who's done a phenomenal job in managing assets in the UK, and that was the next sort of port of call. Probably the third one will be something in Asia, but that's down the line.
Okay, now let's talk about the management fee structures across the three LICs, because as far as LICs go, especially today's ones, they're quite unique.
Yeah, well, let's start with the last one first. Global Masters, there's no management fee or performance fee because it's a passive investment in two LICs that are listed on the LIC, the London Stock Exchange, and obviously on the New York Stock Exchange. So there are directors' fees paid to the three directors, which if you see the fee levels, they're really mediocre. But there's nothing paid to for any management function. That's covered by the three directors. So if we go back to Flagships, that was the one that was first set up, and we wanted to obviously attract retail investors, and we thought the best way to do that was to only be paid a fee if we actually outperformed cash, because that's what they expect from their Aussie equities, is to have outperformance. So there's no management fee in that. There's just a performance fee relative to cash. In Barrack Street, we decided to go with sort of the mainstream approach, but that's because the investments in there are so volatile that if you had a performance fee only, you have periods with high performance and then periods with low performance. So we thought in order to de-risk it from a manager's perspective, we went with the traditional management fee of 1% and then a performance fee over an 8% hurdle with a high watermark. So investors get at least 8% before the performance fee is paid.
Now, going back to Flagship, it's performance fee only. What is the performance fee?
Versus cash. So it's 15% on the outperformance versus cash. So in periods like during the GFC, where the portfolio or the market goes negative, then there's no fee paid in that time at all to the manager. So it's a zero fee in total.
Now, all three LICs are trading at a discount or a varying discount.
Yeah.
I think the Global Masters one trading at the tightest towards its NTA.
Yeah.
The other two are all quite significant. What's driving that at the moment? Is it the size of them? Because they are quite small portfolios in the grand scheme of things.
Yeah. Look, I think that always has a play. I mean, there's probably three factors. There's the size of it. There's the liquidity, the perceived lack of liquidity, obviously, and then it's got to do with the way they are marketed. So if I start with the last point first, we've decided to change the way, because they were really very passive investments for us. We just wanted a retail exposure. And particularly for the fund managers to have an entity where we could own it and then we don't fall foul of trading inside the portfolios, etc. So that was a compliance rule. But we've appointed Boyd to assist us with the marketing. So we're going to now market them the way most of the mainstream LICs are marketed, in terms of having a BDM presence and talking about them, and particularly through people like yourselves. In terms of the liquidity, people think that because they're that small, that there isn't the available liquidity. So somebody might say, look, I've got $100,000 to put in and it's too small, I can't get in. Well, because we, the house, own 50% of Global Masters and 30-odd% of the other two, if somebody came to us and said, look, we're hoping to be a long-term investor in this thing, that's our intention, but we need a couple of $100,000 of stock, we will happily let that go to them to enable them to get on board. We certainly don't want to let it go to people who are just going to trade the discount and play games with it. We want to attract long-term investors in what we're doing. So there is available stock there to be had if somebody comes with the right intention of what they want to do with it.
Right, now, speaking of long-term investors like yourselves, let's talk about some of the holdings in the portfolios. Do you want to start with, let's start with Flagship first. Now, you, in Barrack Street, you look to avoid the top 50. Correct. What of the top 50 do you hold within the Flagship? Right,
so the number one holding is Macquarie Bank, and we've held that for a long time. We do own two of the general banks. We own Westpac and we own CBA. We've never owned the NAB because we always were wary of the offshore assets, and the same with ANZ to a certain extent with their expansion into Asia. So we own two of the four banks, and it's always been us except for a short while where we did own the ANZ. But if you look at it versus what the banks are in the index, we're substantially underweight the banking sector and have always been. So since 98, in the years, there was a period where the banks were the best performing sector for a while. We were underweight the banks, but still had excellent performance. So it's got to do with the stock picking capability that we've got, and it's not about sector weighting because we're not a sector manager.
And now looking at Barrack Street, last time you were here with us, we actually spoke about one of your Barrack Street holdings, and that was Catapult Sports. Is it still in the portfolio today? Because it was in the top 5, I believe, and now it's no longer there.
No, it's not reflected because it's not in the top 5, but it's still in the portfolio. And I mean, the reason for that is that while we're a growth style manager, so we're picking quality companies that have got the opportunity to grow the economic footprint, there is an element of value in what we do in that every day we run models to see the expected return out of the stock, and we compare that to the share price today. So there's always got to be an expected return of the cash plus some margin. And in the case of Catapult, the share price has performed exceptionally well, but in terms of our modeling of the company going forward, we just thought the share price got out of whack. So it's just been a down weighting. It's not a removal from the portfolio, but we weight stocks according to the expected return. So in our portfolio, the biggest holding is the best expected return on a risk-adjusted basis. So it's just got to do with the expected return we were going to get.
Well, with that in mind, your largest holdings are the likes of REA Group, Car Sales. Maybe talk us through your expected return then from this point forward going on.
So all of those, as I said, the weighting reflects the expected return, but there are adjustments that we make as well. So for example, to use the broad cap portfolio, let's say let's talk about Macquarie Bank. It has a high internal rate of return, and obviously it's a massive market capitalization. And then in the life of Catapult, it might have a similar internal rate of return, but because it's a really small company, you can never expect it to have the same weighting in a portfolio, especially when you start to get to managing $1 billion, $2 billion, $3 billion. So there's a liquidity adjustment. So in the broad cap, you will see some of the bigger stocks have got a higher weighting. That might not necessarily mean the IRR is that big, but certainly on an adjusted basis it is. So if we look at the Barrack Street, we've spoken about Catapult, but that's one of the reasons why it's down where it is.
Excellent. And now finally, looking at the opportunity that lies within these portfolios for potential shareholders, we've got clear upside to the share price in Barrack Street and FSI. You've engaged someone in marketing to actually get out there and proactively drive that. Perhaps this is now the time to see the catalyst of that NTA closing. Is that your expectations?
We would hope so. Very definitely we don't like the discount to NTA. But when long-term investors are getting into this, really what they have to look at is what we're doing with the NTA. The boards of Barrack Street and Global Masters have always had the perception or the philosophy that the costs have to be minimized. So it's always been a 3-man board, and that's about it. So the costs are extremely low in those two entities. Flagships had a slightly bigger board and had some other costs that were internal in the company, which we've stripped out and got rid of, and they've been separated out to the manager and elsewhere. And we're reducing the board after Henry Smurden retires on the AGM down to 3. And that was purposely done because we think we're going to be in a period of much lower returns than what we've seen historically. And in that case, you have to have your costs really squeaky clean, and that's what we've done.
Excellent. Manny, thanks for joining us.
Yeah, thank you very much.
And members, thank you for joining us, and we'll catch you next time.